Good day to one and all. This is Dr. Sivaraman of iknowindices.com. If you are able to hear me properly, then let me display the camera over that of the PowerPoint presentation. So I have given the part 1 between 9 and 9:45 GMT of the Tracking the Forex Market Together webinar, and now we are in the part 2 of this particular webinar. This is mainly with regard to how to track the market. By using the market reading technique, I have been explaining it, and they are also being explained in my trading system webinars. And based on that, I have given the call, or I have taken a position in the case of euro, and also given you the suggestion how, in the absence of the hedging in the same pair, one can think of selecting the right pair to use it as a hedging currency pair in platforms like US platform where the hedging facility is not available. So I'll be highlighting what happened to that particular trade, and also before that I will just look into that of the live market code page and explain to you what happened to that of the currencies, what happened to the highs and the lows from that of the European to that US session. Then also I'll explain with regard to the position what I had taken, then suggest a new position for that of this particular session. So let me focus the camera over that of the live market code page. Currently euro is trading around 1.3240, 1.3242, and initially during that of the European session we saw that low as 1.3218, and subsequently they made a dip and formed a new low 1.3202, and they have been consolidating here for nearly about 7 to 8 hours. And during the gap time before the start of the European US session, there was a small dip, and then subsequently during the early US session they are making the firming up move. And towards close of the European session, euro was having a low of 1.5688, and then quickly they made the drop and formed a new low 1.5613 in order to create the sentiment. And when I was giving the part 1 webinar, euro was making about 74 pips negative net change, and then it came down. The GBP was making about 74 pips net change when euro was making about 131 pips negative net change. And now you come across GBP is also showing equal net change of 124 pips, and now it is trading around that of the low. Now with regard to yen, from that of 83.96 it has come to that of 84 level, and 84.15, 84.17 are the levels, and earlier it was about 36 pips negative positive net change, and now it has come to about 57 pips positive net change. So you can understand that over a period of 8 hours they just gained about 20-25 pips. And in the case of USD CHF, it was making about 17 pips positive net change, and now it is making about 25 pips positive net change. We can just review it that it is holding above that of parity 1.0028 and 31 are the current levels, and afterwards it has not gone to that of the low. At the same time they breached the high 1.0034 and formed 1.0038. Such a subdued move has happened in the case of USD CHF. And in the case of Canadian dollar, it made a quick gain from that of 1.0202 to 1.0245 and then fell back, and now currently trading around 1.0190. So it is making about 102 pips positive net change. At the time of discussion, it was making about 69 pips positive net change, and from there it has gained and now come back and fallen from that of the high. It has fallen nearly about 50 pips. Then in the case of Australian dollar, it was trading around 96.65, and then it has dropped quickly from there and 96.14, and it has come back to that of 96.53 area, and it came down closer to that of 196 pips during that of the European session, and it regained the levels. So what do you identify from these moves here? It is being Friday, and the players know that the traders are holding the long positions, and they are just making the circular trades and making a drop and gain Thereby, those who are holding the long positions, they are just liquidating the long out of fear of the margin call, etc. And subsequently, somebody has bought it in the market. So either the higher level short sellers, they have just closed their positions before the weekend. That could be one possibility. The other possibility is when a huge amount of selling is happening and somebody should be becoming net long. And when they are going for a net long, because always you come across equal positions in the market, and whatever the positions which are taken from that other market, they are to be liquidated in the market, and you cannot take delivery unless and otherwise you go in for a currency conversion trade, because these are all the leveraged positions, and that is why you come across various systems operating in forex market, whereby you find that the positions are to be closed in the market. Only thing is, unlike that of the derivative market like futures and options, you don't have a deadline to close the positions, and you can take the positions and they are all leverage positions and you can only close it. And so keeping that in mind, whatever the positions we are taken, we have to close it. Similarly, the players also need to close it. So only thing is, they drop the market and accumulate the positions and they become let long and subsequently gain the levels and distribute the positions by creating the bullish field. So now they are doing the bearish, they are creating the bearish field in the market by making small dip every time. And now, you would have noticed that euro went up to 30 to 61 and quickly dropped to 30 to 38 and by 15 GMT. That is mainly to give the impression to the traders that euro could fall further down during the US session. So they can create the sentiments by making circular trades by 20-30 pips. That is circular trades in the sense that they sell as well as they sell buy using two different terminals or several terminals. As a result, people who just watch the market think that something big happening in the market because of the various crises. So from time to time, they can talk about various type of crises and they can make the moves, and if no proper definition is seen in the market, they can talk about technicals and they can simply say it was oversold or Fibonacci retracement and things like that. So they have always their excuses to explain the possible moves happen in the market. So traders also generally get convinced with regard to such excuses and they don't question that afterwards. Say for example, when after the Fed announcement of quantitative easing too, and euro and GBP were rising in a very big way, at that time everybody was focusing on US problem and nobody was pointing the finger towards that of the Irish problem. And now the Irish problem is being exaggerated, and you find that if Irish problem is going to remain forever, then you will get surprised again. And they may probably talk about the US problem again using some data release or releasing some news. Thereby, they can reverse the market. Only thing is, we need to understand that they don't have any definite idea up to what level they wanted to drop the market. So they drop it, breaching the supports and come down. Then technically the support turns into resistance and they make the moves in such a way that it is not going above that of the resistance. Then when they continue to drop, they expect the traders to liquidate the long positions and turn short. And when the traders are not liquidating the long, then obviously they have to do the circular trade and drop further down and show that the usable margin gets eroded for that of the traders. And you know that huge volume is happening in the market. And when we are all talking and watching the market, somebody is making the trade. You question all the people or the traders whether they are doing the trades continuously in the market like this for every 1 pip, 2 pips like a scalper. And everybody will say that we are all watching the market. So when we are all watching the market, somebody is just doing the trades in the market and they are all nothing but the circular trades and they create the sentiment that way. So they quickly drop the market and accumulate the positions, and if the traders are not willing to liquidate the long position, they continue to drop and see that the traders liquidate. Besides, they want the traders to turn short. So once the support becomes a resistance, then the traders develop the mentality or the mindset using the technicals that we can short. And definitely by doing sell and buy trade near that of the low or buy and sell trade near that of the high will look lucrative. So only then the traders will get convinced, okay, sell and buy trade is the easiest way of doing it. Then they will do one mini lot to start with and see how exactly it goes. Then subsequently, when they find the going is good, they will commit more and take more positions so that they can grab the entire profit from the market. Commit all the positions beyond their capacity, and the players simply gain about 300 to 500 pips and attract margin call. So what they have earned by sell and buy, small sell and buy trades for about few days during the consolidation, they just lose it in one go. So you can ask every trader objectively whether changing the mindset alternatively from that of the buy and sell to sell and buy, whether they are able to consistently earn from that of the market, or anybody who is in a position to use the common sense that when the market has gone up, so it is not advisable to do buy and sell trade. And we will look for some of the sell and buy trades. Similarly, when the market has bottomed out or dropped considerably, then doing a sell and buy trade will look promising. But if you use your common sense, you will find that it is not advisable. Because at the bottommost level, if you try to sell, probably we may earn about 20-30 pips profit, but the chances of getting trapped is vulnerable. So if the players need to make money by using their own money power, and they have to be cunning. So we have to understand that they continuously show their cunningness, and they use various types of tools for the traders to believe and trust, and then subsequently they try to earn from that of the traders. So if you try to follow that particular method, then obviously one day or the other will get trapped. So instead, I give an importance to that of the trading strategy, which I explained in my trading system, explaining the overall market operations. It is not that at a given time how exactly they are making the moves, but we need to understand over a period of time how exactly they make the moves in the market. As I explained in the previous part 1, that the players cannot go out of the market, and they have to rise the market and distribute, drop the market and accumulate and continue to act. And from time to time, people might be talking about various currencies and various currency crises, and they might say that this particular problem is bigger than the other problem, etc. They are all relative comparisons. One can use it, but if you go by that, the chances of getting trapped and emotionally committing in the market in the wrong side, the chances will be very high. So let me go back to that of the PowerPoint presentation. And now we will see what happened to that of the trade. Now, during that of the European session, around 10 GMT, the last 30 minutes of my observation, I kept an initial buy order at 1.3225, and they are not filling it. And so before closing the webinar, instead of keeping a limit order, I just taken a position 1.3250, 25 pips above that of my initial position. Then I also explained how exactly in the absence of hedging in the same pair is not available in the US trading platform, we can choose a currency which is making the similar net change. So at that time, when Euro was making about 120 pips negative net change, USD CHF was making 120 pips negative net change, wherein USD CHF is a cross where Euro is in the numerator side. So when USD Yen is on the denominator, USD CHF is on the denominator side, when they hardly made about 18 pips positive net change in the case of USD CHF. So it was almost flat. Then whatever the move euro is making, USD CHF will also expect it to make. And on that basis, I kept a sell limit order 30 pips below that of the market. At that time, it was trading around 1.3271. I kept a sell limit order because I improved my buy order and took a buy position at 30 to 50. I kept a sell order 1.3245, 30 pips below that of the market in the case of USD CHF. And subsequently, during the late European session, it got filled. And you know that from the live market quote page, you can understand that Euro CHF came down to 30 to 37. Then at that time, I kept stop at entry in my sell position of, so this became the sell position. Then I kept stop at entry. And afterwards, they are not made any drop. And subsequently, that position was closed with no loss. So I just used the hedging to limit the risk. And if in case if euro drops to 1.31, so I will not be vulnerably exposed in the market. I don't have the hedging facility in the same currency pair in the trading platform, like a US trading platform. Then obviously you can think of a currency pair which can be relatively safe and could make equal quantity of move. Thereby, when euro drops about 30 pips, euro CHF would have dropped about 30 pips. Then subsequently, I will find that when whatever I am losing in euro buy position, I will be able to gain it from that of the euro CHF position. So that is the basic idea of using hedging, because I can use any type of forecast or market reading or any type of technical analysis or fundamental analysis, and there is no guarantee that such analysis can be 100% perfect, and there will be limitations. And during the time of limitations, I could be stopped out in case I use the stop. And the traders have got the tendency of avoid keeping the stop because they had bad experiences. They fill the stop and go up as per their expectations. So the traders tend to keep stops, and you come across nearly about 60 to 65% of the traders, they trade without a stop, because the way in which I see the questions asked and things like that in the blog, I understand that small traders especially, they have got the aversion of keeping the stop. In the absence of, or with that mindset, if I insist that you have to use stop, and that is not the solution. The alternative is, for the prevailing mindset, what could be the possible trading strategy? Thereby one can limit the risk. And so I suggested that you can identify a currency pair looking at the live market quote page or looking at your platform wherein you come across a similar net change. Say for example, euro made, for example, 110 pips positive net change, and you like to make a buy. And you look into that of USD CHF, which has made about 150 pips drop, then you can keep a buy limit order in the case of USD CHF as a hedging for a buy position in the euro after the rise. So that way, when both the net changes are equal, you can choose a currency. So if euro and GBP make equal net changes, then you can use GBP as a hedging tool. So this is how you should be able to identify. Instead, simply if you take USD yen as a hedging tool for euro, for example, I had taken buy position in euro and buy position in USD yen would have gained about 20 pips, whereas euro would have dropped about 50 pips. So still my usable margin will get eroded. So this is how you should be able to identify the right pair for that. Then subsequently, when I was stopped out at entry, I am not taking an unlimited risk, and immediately I kept the new hedging order around 32.35 because the low set was 1.3237 in the case of euro CHF. So I kept it at 3235. Now currently euro GBP has moved, euro CHF has moved to 1.3281. So 30 pips above, so moved to 1.3250. So just 30 pips below from that of the current level. Currently it is trading around 1.3283. So 1.3250 I kept the hedging order. It's only an order. So when I move the order till such time, I'm able to keep stop at entry in the buy position. Now euro is making a nominal profit of about 6 pips. So I will wait for euro to make about 20 pips profit. Then I'll keep stop at entry in euro and remove the hedging order in euro CH. So this way, if you do it in a mechanical way, then there is no fear. So if you simply think that euro can go to 1.31 or it can go to 1.30 or 1.28, then probably when they come to 1.31, still you will think that there is a scope it can go to 1.27. Then once it comes to 1.27, you will think that it can go to 1.25. So you will never be in a position to take a trading decision. Then subsequently when they rally, immediately we have got a tendency that, okay, 1.37 turned out to be a resistance after acting as a support. Fine. When they come to 1.37, I'll try to take a sell position. This is what the technical indicators explain. But what is a guarantee? When the players have raised from 1.32 to 37, about 500 pips, that they need to drop it. Are they fools just to buy and rise the market up to that particular level? For everybody to take a sell position there and then afterwards drop? So if you question that, then you will be able to understand. It is a man-made market, and without men action, market cannot move on its own. And somebody has to make the market to move by buying continuously or selling continuously. So why they should rise it up to that particular level as support turn to a resistance level and drop the market? They make the market appear like that. They will come up to that level and make a dip. And if you fail to book profit after taking a sell about 30-40 pips, they would have dropped, or even sometimes 100 pips, and quickly reverse it. If you fail to book profit, it will go up and hit your stop. Then afterwards it might make a further drop. Then immediately people think that, okay, next time when it comes up, I will try to do a sell. But next time it is straight pass through the support, turn to resistance, and then it acts as a support. Okay, fine. We can say that the support has become a resistance has become a support, etc. But ultimately, what do you try to achieve out of that? Are you benefited out of your analysis? And there comes the important question. I can be a very good analyst, but I need to know whether I am able to trade effectively in the market and try to earn without any fear. Because you know very well, the quick moves in the market, they are nothing but the moves to trigger the fear. If I am still having that fear in the mind, I will not be in a position to take appropriate decisions. You would have seen that many of the people do the technical analysis, and out of fear, they are not committing their positions, or they are not committing in the market and not taking the positions. And then subsequently, they say that I missed, even though I made that analysis, I missed. Because only if we get rid of the fear, why the fear comes? Because of uncertainty. And also the fear comes because of the wrong happenings in the past. So it is all nothing but the experience of the past which is triggering the fear. So ultimately, if you want to be a successful trader, you need to remove the element of fear from the mind. How it is possible? If you use the trading strategy, and I am taking a buy at 1.3250, I am only taking a risk of 30 pips. Whether I buy it at 1.37 or 1.32 or 1.30 or sell, whatever it is, I am only limiting my risk to 30 pips or 40 pips. So if you have the mindset, then the fear will not be there. If you use the stop, we know very well the stop will be filled. So obviously, the fear is not going to be eliminated when you are frequently stopped out. Because there is a hard-earned money going out because of the stop being hit. So the only way to handle it using the trading strategy. So I am not here to preach the forecast or justify the forecast is right or my readings are right and things like that. I am here mainly to explain that everybody need to develop their own trading strategy. using their common sense, and there are people who are giving various type of trading strategies, and go through all those things and fine tune and identify the right type of trading strategy depending upon the type of trading platform you have, with the leverage, whether it is 1:50 or 1:100, 1:200 or 400 and things like that. Then subsequently, the time available for trading. Nobody will be able to do 24 hours trading, watching the market. One has to sleep. So obviously you have to find out what is the time suitable for you to trade, and then you also find what is the usable margin you have, how much of positions I can take. I can take only one or two positions, 1 or 2% of my equity as a position and take risk. So you know very well everywhere the disclaimer comes. When you are opening an account, you are asked to sign a disclosure or that you are willing to accept the risk. So trading means risk, but you have to justify and define the risk as a limited risk. And for that you need to identify the right type of trading strategy. So there comes the importance of trading strategy. It is not that either you use the technical analysis or fundamental analysis or any other algorithm. Ultimately, one needs to use the trading strategy to limit the risk. I wanted to emphasize it so that you will always see that when the loss is small, you will be able to accept it. When the loss big, you will not allow the loss to become big. At the same time, when the profit becomes small, you will not grab it immediately. You will try to keep stop at entry as a trading strategy and trail it up and try to maximize the profit, keeping a limit as well as a stop. The market can fill either the stop or the limit. So this is very, very essential with regard to the trading strategies. So this is what the position is currently. Still Euro is making about a nominal swing around that 1.3250, and it came down to 1.324143 currently. And GBP is also holding low, but in the first 30 minutes they are not breached the low. So this is what the basic trading strategy is. So now let me explain with regard to the timings. I already explained it many times. So US session starts by 14:30 GMT. Now we are around 15:29 GMT. 30 minutes is passed and now 1 hour is passed. So what is the basic trading strategy? Watch the market in 6 pairs, 2 majors and 2 commodity pairs. Then take a sell position if the pair is near that of the high. If the high is not being breached in 30 minutes of watching, or take a buy position if the pair is near low and not breached or cut the low during the 30 minutes of watch. So now you find that Euro and GBP, they are not breached with a low. So one can initiate the buy and sell trade. Already I have a position in the case of Euro. So let me take a position in the case of GBP and try to explain to you what could be the suitable hedging currency for that. Now, then afterwards keep 30 pips hedging order if the hedging facility is available in the same currency pair. Otherwise, you try to identify a currency which has made similar move and try to keep the hedging order 30 pips below that particular currency. So that is how one can take the trade. And once the position makes profit, keep stop at entry, 20-30 pips profit, keep stop at entry and remove the hedging order in the other currency pair so that you are reducing the risk to nil. Then keep about 30, 45 or 75 pips depending upon the market swing. So when the swing is very good, you can keep about 75 pips. And if it is optimal, very sluggish, then keep about 30 or 45 pips and use the trailing stop and see. Or simply grab the profit when you see 30 pips. That way you can try to close it. So what the profit you earned is a profit earned. Then you can always continue to do the trading, and market is known to give trading opportunities from time to time. So there is no question of that you missed the trade and things like that. The level is not important and only the trading strategy is important. And after taking, say for example, when I take a buy in Euro at 1.3202 or whether I buy it at 1.3245, ultimately my objective is you should make profit. So Either it makes 30 pips or 45 pips. It depends upon my mindset in closing the position, whether I want to do it as a swing trade or a position trade, etc. And for entry and exit, always you have to see that they are not breached the low, and you can try to take a buy position, and you are trying to wait to keep stop at entry. Then when they start gaining, then you always see how they are handling the high. They come up to that of the high and not going above that of the high, then probably near the high you can close the position. They breach the high quickly in 30 minutes or 45 minutes and sustain above that of the high. The initial high, what do you come across in live market put page? They sustain above there for more than 30 minutes. Understand they wanted to make an extended move for 2 hours. Then wait for the 2 hours and try to close at the prevailing market level. So this is how the entry and exit levels are to be determined, and statistically if you determine, and there is no guarantee that the market will respect those levels. So the forecast says, the algorithm says that Euro and GBP are expected to make swing and rise moves for weekend during that of the US session. So based on that, I have already a buy position in the case of Euro, 1.3250. Now, I explained it during that of the part 1 of the webinar. As soon as you are taken a position, in case you are not willing to keep hedging order, or you are not willing to keep a stop and things like that, and you want to make quick money from that other market, otherwise exit, then after taking a position, whether you sell or a buy position, the position does not make profit, then try to close it with a nominal loss of 1 or 2 pips or 5 pips, 10 pips, and then wait for 2 hours, then review the market. Otherwise, you watch the market during session start, first 30 minutes from that of the session start, or watch the market during the last 30 minutes. They will always make quick moves in majors. At that time, you can quickly enter and exit out of the market. So one option was closing it with a nominal loss of 5 pips, or closing it stop at entry and things like that. There is one possibility with regard to Euro. I'm not here to just say that get out of the position, because I know that they cannot keep Euro at 1.3244 forever. And in this particular session, they are expected to make a quick rise. So I'm just holding it, and so that I'll be able to explain to you their trading strategy, because most of the traders, after taking the position, they become possessive of the position and they don't come out of the position even though the market drops. So then at the prevailing condition, how exactly they can handle the position, that is why I just given an idea how a cross or other majors could be used as a hedging currency. Now, as I explained, that GBP formed the low 1.5613 and 136 pips negative net change is seen, and they are not breached the low from that of the session start. So they made the downward move in the case of GBP during European session, but not in the US session. So I will keep a buy limit order around just about 5 pips above that of the low 1.5618. So 1.5613 is the low. Currently they are trading around 1.5621, 1.5626 or 25. So just keeping about 5 pips below that of the market, so that I'll be able to fine tune my entry. Simply, instead of taking a buy position in the market, I will try to keep a buy limit order and see whether they are filling it. In 30 minutes of time frame, if they are not filling it, I'll modify and buy close that. And so that way, if you fine tune your order, then the stop being filled will be lesser. Even though statistically you might calculate, you know that in statistical calculation or in chart study, you come across the condition as noise. During such noise, if the position is stopped out, then you will feel bad. So obviously you do not know how big the noise is going to be. So obviously the best way is keep the limit order slightly below that of the market after seeing all the conditions that in the first 30 minutes they are not breached the low. And yesterday you would have seen during the US session, the first 30 minutes they had breached the low. That is an indication that they wanted to make an extended downward move for 2 hours. So which I was explaining in the blog. So now I am keeping a buy limit order at 1.5618 with suitable hedging currency. What currency I can do it? Now Euro is making. Let me just focus the live market code page and shift the camera to that live market code page. Okay. Now we come across that Euro is making about 116 pips negative net change and GBP is making about 136 pips negative net change and 50 pips only in the case of yen and 17 pips. So these things cannot be used suitably for GBP. Equivalent net change should be seen or almost closer to that. Then Canadian dollar is making about 113 pips positive net change and Australian dollar is making about 158 pips negative net change, almost closer to that of GBP. Otherwise, you can take a GBP currency. I don't have all the GBP currencies here in this particular live market code page. You can see whether GBP CHF is suitable to CHF because CHF they are holding it. Probably GBP CHF could be a good currency cross which can be used for hedging. Otherwise, you come across Australian dollar has also made about 159 pips negative net change that can be used as a hedging. So currently Australian dollar is trading around 1.9647 and the low was 1.9614. So from the low it has gained about 30 pips. So we can straight away keep a hedging order below that of the low. So let me focus the camera again here. So I'm using hedging AUD USD entry stop sell limit order 30 pips below market. So that will be 0.9604. Sorry, 14. Okay. So I'm just keeping it closer to that of the low, what they have set as 0.9614 and currently trading around 0.9646. So 30 pips below I kept the hedging order which is a sell limit order. I am not hedging it immediately. It is not either way trading. I am just keeping the limit order 30 pips below the market just to limit my risk in taking a buy position in the case of GBP. Now GBP is trading around 52, 56.25, 56.29. It's not coming down. So let us next dip try to buy it around 56.20 or 56.21 because slowly they have started gaining the levels. They are making small swings here, Euro dip and GBP rise and GBP dip and Euro rise. That sort of moves they are doing it in order to make a little bit of moves in the case of crosses, and from the mid session after handling briefly the crosses they are expected to go up. Now if you see that when corresponding moves are not happening in the case of Euro and CHF and things like that, you can identify there could be potency also. You can take as a safe trade strategy in the case of USD CHF a buy position because they have done a consolidation above that of the parity. Anytime they are expected to make an upward move. And yesterday you would have seen that Euro was making a positive net change during the early US session and USD CHF was also making a positive net change, and that indicated that they wanted to make the contrarian move in the case of Euro CHF again. So in order to handle the crosses, they make such contrarian moves. Euro might be making USD weakening move and USD CHF might be making USD strengthening move. That sort of moves they try to do it in order to just to gain the levels in the case of the respective crosses. So you have to identify such contrarian moves and also choose the safe trades. It is not that always USD gaining moves will be seen as a prevalent move in the market or USD losing move will be seen all the time. See, so it is not that way by which we have to go by. You have to see the net changes on a day from session to session and see which currency can be chosen. And accordingly, you can do further analysis using your technical analysis and fundamental analysis. And finally, take a position. So mine is an additional input of market reading using the live market quote page, and that is not all for your trading decision. And you can use other things also so that you'll be able to identify a certain amount, to a certain extent, the direction of the market. Then accordingly take the position. So the position will be very, very safe and the stop will not be filled. And that is my basic objective. So let me minimize the PowerPoint presentation. So this position I explained, and probably you can analyze it on yourself what happens to this particular position. So let me spend some time answering to the questions here. Yes, it's getting closer to the webinar time frame allotted. Then pause it. What time frame do you expect euro to normalize against CHF, yen and Australian dollar? Which one will be the first? Okay, now you come across the extreme moves. You know that USD CHF was in extreme level for some time, and USD yen was in extreme level for some time, and they have been oscillating around 82 to 81 and things like that, 83. Now only it has come to that level of 84 slowly. Similarly, USD CHF has also come to that of the parity, and Canadian dollar was briefly going below that of the parity, now started coming up. So with regard to these currencies, you know very well now, they are not going to perennially keep in those levels. They have to necessarily make moves in the market, otherwise notice that things change from second to second, the pip variations, and those things, and they probably give the excuse that the problem is being discounted and things like that. They can give any sort of attributes, but ultimately what you need to understand is the players create the market, and they create the market sentiment and act against that of the traders. So if you understand, then you'll be able to freely look for the normal moves to come into that of the market. And if you simply develop the bearish feel and try to avoid taking current positions in a respective currency and things like that, only thing is you will not be participating, but the market will go on forever. Then we have already seen that CHF has come above that of the parity. USD has come to about 84 level. As I explained, that it will slowly come to about 85 to 86 level. Then subsequently you will come across this going to 91 to 93 level by December. Then you will come across yen will be identified as good trading currency by many of the trades. And similarly USD also. Then Australian dollar, it has shown the parity, and subsequently it has made the drop, and it is not going to give up. And this is the currency you are going to see again going to make the extreme moves, similar to what the extreme moves we have come across in the case of CHF and yen and also Canadian dollar. And euro and GBP, they made the extreme moves in 2008. They took euro to 1.60 and then dropped in 2009 to that of 1.18. And similarly in the case of GBP, they took it to 2.13 and then subsequently dropped it to 1.38. So all extreme moves, they have done it. And now only currency left out was Australian dollar. So that they will try to do it. So don't sell or don't try to do that. You can technically do a sell and buy trade in the case of Australian dollar. Probably intraday you can think it with a tight stop and keeping stop at entry. But try to do buy and sell trade in the case of Australian dollar. Then new it. How to determine which level is the bottom or top? Yeah. Now, no one will be able to decide the bottom. Any technical analyst for that matter, fundamental analyst, they can say that it is a support. And if it breaches, then immediately they will say the support turned resistance. That's all. And nobody will be in a position to determine. But if you take into consideration that they normally make the swings on a monthly basis about 900 to 1100 pips in the case of euro and about 2300 pips in the case of GBP as a monthly limit, then you will be able to understand that they have come to that of the bottom now from that of 1.43. So this is how we have to estimate. Probably what you can do is you do the analysis on a month by month basis, and the cycles are not exactly 30-day cycle. You come across the prime numbers are being followed by the market. Sometimes you come across the cycle is of 29 days, and certain other times you come across the cycle is of 37 days. So you try to take the time frame of about 40 days and try to see what is the lowest level and what is the highest level in that particular currency in the month. Then you will be able to understand from the beginning of the month to the end of the month they would have done such moves. And similarly, sometimes you come across they continue the move in the same direction another month also. That month also you try to make a measure. You'll find that first month they would have dropped about 1100 pips. The second month they would have dropped about 600 to 700 pips. But you might think that from the high it has dropped nearly about 2000 pips, but they have taken 2 months to do that. So that is how they make the moves initially. Then you come across that once they reverse, they will also do it in the same way on the upside. So because they drop to a certain extent and see whether the longs are liquidated, because the traders have got a tendency to avoid keeping stop. So what is the next alternative? If the traders avoid keeping stop, then drop, induce the fear, then automatically they liquidate. Okay, that is the next alternative strategy the players follow it. That is what they do it now. So the bottom they don't know. And can anybody say that, okay, it is Irish problem, the market has to drop 600 pips for that. It is a Greece problem, so the market has to drop about 900 pips. Can anybody quantify that? No. So the sentiments don't have any yardstick to measure. So obviously you need to understand that the players create the sentiment and intensify the sentiment so that the traders liquidate the positions. Holding adverse positions, they liquidate. That is what ultimately they wanted, so that that money they can earn from that of the traders. When the traders lose, the players earn. So when the huge billions and billions of dollars to earn money, no bank will be able to accept it as a deposit and give interest. And that has to be deployed in the market as investments. And they know the quantum of risk involved, and they try to control the risk, and they don't use stops. And they try to control the risk by making massive moves when the traders are all waiting for the data release and the volume comes down. So they have their own strategy, but we need to understand the strategy and trade. There is no other go, because you know that there are a lot of limitations with regard to the players, with regard to that of the trading platform itself. Your own trading platform, they trade against you. So who will be the biggest enemy for you? Your own trading platform providers and then also the players. So we have to defend ourselves. There is no point in blaming the players or anybody doing the analysis. That is not going to help us anyway. Then drop. Volume might die out on as normally seen in Friday PM. No, it is not necessarily that the volume need to come down all the Fridays. There are so many Fridays, you just see the market has made spike moves. So don't generalize that after seeing about 3 Fridays, don't think the 4th Friday will also be like that. And yesterday, similarly, when people thought that the market is going to be in a holiday mode, so there may not be any move, whereas they made about 100 pips move during that of the US session. So never generalize the market conditions. The players continue to make it depending upon the traders' positions and balance. I like to trade with a hedge, but as of lately, I am getting the direction, but getting sometimes at the gap and the US session reversal. Yeah, obviously when you are using the hedging, you have to use 30 minutes rule to come out of the hedging and keep fresh hedging order and start moving the hedging order. Probably you might be keeping the hedging order, and when the second hedging order is filled, you become frustrated. Then when the second hedging order is filled, give about 2 hours time. You know that they are making extended move, so you have to give 2 hours time. Afterwards, you release the hedge, book profit in the hedging, or keep stop at entry in the hedging. Let them drop wherever they want, and ultimately they have to reverse it. After the reversal, you can stop out at entry at whatever level you are holding a sell position, and continue earn from that other buy position. If you're smart enough, you can book profit on the downside as well as book profit on the upside. So that happened yesterday, and today what do you suggest to avoid such situations? Obviously, you have to be very calm and you should not be impulsive. When they make a small rise, say for example, euro went up to 1.3258. If you would have kept a stop there, they would have stopped me out. I can re-enter again. That is not a big deal. But that is why I said that let them rise about 20 pips so that you can keep stop at entry. So the chances of getting stopped out will be reduced. So we have to always look for a better chance. But still the market can act against at any given time. Always keep it in mind that nobody will be able to give an assurance that the market has to go up from this point or come down from this point. They are all nothing but the assumptions, using various excuses, including technical analysis, and there is no guarantee that it has to be honored by the market. In New Age, Euro CHF, the low of 1.3237 was traded for about 1 minute and moved higher. How did you manage? So when it has dropped, no, it was not trading for 1 minute, and they kept in fact a sell order at 1.3237 for about 2 to 3 minutes. You just, if you have watched the live market put page, you would have understood. But when you look into that as a 5 minutes chart, then it will appear as if it has happened for 1 minute. Then only I kept stop at entry at that level. Otherwise also I gave an explanation that you can keep 30 pip stop in the hedging if it is filled. And if you do not want to close your hedging order, and you can just top out with a 30 pips loss and then subsequently earn more than 30 pips in your buy side. So these are all the alternative strategies. Then able. But isn't it what most teach? Chart patterns are repetitive and we should expect the same reaction as a particular support or resistance level. So have you seen in life that every day repeats on a similar way? If you superimpose the charts on a daily basis, you will come across that they never make same moves. They may make similar moves. It may appear similar, but not the same move. So we have to understand that. Now GBP, they are trying to come closer to a buy order, and if it fills, it becomes a position. So if you calmly wait, they will be able to give it. So let me explain. I'm not trying to comment with regard to the technical analysis. I was also using technical analysis for nearly about 12 years. Not only some of the, not the way in which you are all using it now. Simply, you call for the analysis, it gives the moving average and things like that. At that time, and no, this technical analysis was available free of cost, and you have to pay a premium for such technical analysis to be available for us, and we have to subscribe for it like $300, $500 for a month, and such analysis tools will be available and we can use it. And I used to do the manual calculations of all those analysis and try to use it in the market from time to time. I found a lot of limitations, and that has given me the trigger for me to develop a system which will be in a position to relatively give a safer trading ideas or the directions of the market from time to time. So on that basis only I am giving the daily analysis, and still I am working on it because the market is dynamic and the conditions change. So once I perfect it, probably I'll start releasing it and you can use it as a tool. So till such time you have to give time for me. It is not a joke just to develop a system. You should understand. Then able. I missed the first part and no worries. Okay. What's the recording? Choice of Euro CHF. Okay. I explained during this webinar also why I chosen Euro CHF as a hedging currency there, because they were making similar moves. So now my GBP order is being filled, so that becomes a position. Okay, enable. You mean once position makes loss of 5 pips, we close once if there is no hedging? No, I said that you wait for 2 hours. And in that 2 hours, if it is not making profit, when the market comes closer to that, close it with 7 pips loss or 10 pips loss or 12 pips loss, things like that. That's what. Not a definite 5 pips, or try to keep stop at entry and just stop it out. That is one strategy. That is not all. That is one of the strategies. Then was Aussie USD a hedge because it has negative net change and trading at the high? Yes, because GBP has made about 144 pips now, negative net change. Aussie has done about 172 pips net change, almost equal. So in case GBP drops, then Australian dollar also tend to drop. I kept the hedging order 1.9614. Just for now, my position is filled 1.5618, and that 5 pips above that of the market, I kept it because they are not breached the low. I am not expecting them to breach the low, but still they can breach it because nobody can control them. But normally they don't. On that assumptions, I had taken 5 pips above the hedging order. I mean, taken the position, and now the hedging order is 30 pips below that of the market. So I can move the hedging order 30 pips below the current market also. It is 96.02. I can just keep it like that because now only my position is committed. So this is how we have to fine tune the levels, and simply we should not assume that as soon as I take the position, my position should make profit. And able. Isn't it a fact that this time of the year the USD normally gains? No, we just look into 2004, 2003, 2001. Every time during the December, USD was losing in a very big way. So not all the years they will do the similar moves. They don't repeat at all. If they repeat, then probably they will make you to just perceive that they are going to repeat. But suddenly they reverse it. And we have to keep an open mind and see. As per my algorithm, I am expecting them to rise in a big way in this particular month, December. Let us see what happens actually. Then balance. A big key is know that the players create the market sentiment and act against it. But they usually use a catalyst to make them move against. So it is not important to truly understand the sentiment. Like today, Euro news was not so good. Therefore, do you think that they will act against the sentiment now without a real catalyst? I am curious. What do you think? So, as I explained in many times, that they can either use the data release, and day for yesterday, for example, Thursday and Wednesday, the European data and the UK data were so good, but they did not even rise 1 pip upwards. So if you think that the data is going to really make moves in the market, then they can disappoint us. So keep an open mind, okay? They are not rising it, so they intend to drop. So try to conclude it that way. Or they might keep it sideways. Then FX world. Surely there are many players. How do they act? Yeah, it is not many players. It is a consortium of players. They all act against as a group. And they are all distributed in different countries, but nodally controlled from US. Only that much I can tell you. Okay, screen is black. Okay. Now, what is your view on gold? Okay, gold is now, if you come across, it has made extreme levels above that of 1,400 and made the drop. And you know that the players made the quick rise and just booked the profit in those positions. And subsequently, they are just let loose gold, and it is making nominal moves now, not a big way like $30, $40, etc. And it is expected to make a range bound move around 1,385 to 1,335 level. It is expected to oscillate for some time during the year end. That's what my estimate says. So let me go back to that of the PowerPoint presentation. So now the buy limit has become a buy position. So the hedging, I just made it as 30 pips below that of the current market level. So sell limit in the case of Australian dollar is 96.04. for me. As a preventive measure, I'm using another major now. So it is not that always you have to choose a major. You can choose either a major or a cross, but you have to understand that when you choose another currency, obviously you have to block the margin for that particular currency also. But in a trading platform where the hedging is available in the same currency pair, they may not take the margin for the additional opposite position. So that is the only disadvantage, but still to limit the risk, you can take certain amount of exposure in the market. So let me conclude my talk. So I take this opportunity to thank everybody and also Apex Street for the time slot and also for your patient listening. And don't become bearish. That is my humble request. And they drop and buy. And when the traders are not liquidating, they continue to drop some more, but they will reverse it in a very, very aggressive way. And don't simply become bearish and imagine certain levels, then that will create more and more fear and uncertainty. Then it will make you unfit for trading. So control your fear, limit your fear, and try to wisely look at the market, what they are trying to do, and try to act upon. Thank you one and all. See you again on Monday during Asian Session Live Market Analysis. We will continue to do the analysis on a daily basis. Thank you one and all. Bye.